Kevin Prendergast, Director of Wealth Management at Leland Smith. I'm recording this video on Friday, June 10th. The big headline news item today was the Consumer Price Index, CPI. It's a government measure of inflation, came in at 8.6% year over year, highest since 1981 and higher than expected. The US stock market was down about 3% today. While the US stock market is a complex system and a number of factors influence stock market performance on a given day, certainly inflation is a big one. And the perception is that the stock market does not like inflation. That's what's especially unexpected inflation. That's definitely been true this year. And so a natural question to ask is, is the stock market the right place to have my money? Is the stock market going to protect me from high inflation, particularly unexpectedly high inflation? So let's talk about the theory as to why stocks are capable of protecting our money from inflation eventually over time. It takes time. And then let's look at some historical data. The 1970s is a decade or a pretty rich, provide us with a pretty rich set of data because inflation was persistently, stubbornly high for the decade of the 1970s. So we'll look at some historical data on the screen here in a moment, but let's start with the theory. What's the theory? Well, inflation is rising prices for goods and services, generally speaking. Okay, so we've got that on the one hand. Inflation is rising prices for goods and services. On the other hand, what are stocks? Well, stocks are ownership interests in companies selling those goods and services, producing and selling those goods and services. So you can see how there's an alignment there, right? Because the rising prices for those goods and services is going to influence the revenue of the companies producing and selling those goods and services. So there's somewhat of an alignment there. That's the theory. We like that as investors in stocks, because the whole point of investing in the first place is that inflation is going to be something positive in the future. That's kind of our starting assumption. And so we need to protect our money from inflation over time. Otherwise, we're going to lose purchasing power. So if we just put all of our money in cash, earning 0 to 1% these days, we're going to lose purchasing power slowly over time. That's why we invest in stocks. So that's the theory. Yeah, there's an alignment there. Inflation is rising prices of goods and services. Stocks are ownership interests in the companies selling those goods and services. There's an alignment. That's the theory. What does the data say? Professor Demoterin at NYU makes a great data set available to all of us for free. Anyone can visit this website that you see on the screen here. It goes all the way back to 1928. So a lot of history there, coming up on 100 years of history. And on the left-hand side, you can see the S&P 500, so the 500 largest publicly traded companies that are domiciled here in the US. We're looking at the dividends those companies pay us as shareholders, plus the price movement, which can be highly variable year to year, but as long as there are more positive years than negative ones, as there have been historically, and as long as those positive years are larger in magnitude than the negative ones, which again, they have been historically, it's been a pretty good thing to do, investing in the S&P 500. Over here on the far right-hand side is the inflation rate. So we have all the data we need conveniently in one place. So let's scroll down to the 1970s, which you see we have highlighted here. And the S&P 500 returns, there were some negative years in there to be sure, 1973, 1974, but overall some pretty positive performance, more positive years than negative ones. And then on the far right-hand side, we can see that inflation was stubbornly, persistently high for pretty much that entire decade. Okay, some pretty high inflation readings. And so if we total up all these numbers here, let's take someone who hypothetically invested on January 1st of 1970 and then held those investments all the way through December 31st of 1979. What was their return? Their total return was about 80%, 80% for the decade. And on an annualized basis, that's about 6% per year. That's below average historically. The historical average is closer to 10%. So below average historically, but still meaningfully positive. Stocks still provided meaningful protection against inflation over the course of the 1970s. Okay, so hopefully this is helpful. If you have any questions, if you'd like to discuss your portfolio specifically, please contact your advisor. We're happy to talk through this very, very challenging environment. All right, see you next time.